All right, good evening, and welcome to another episode of the Weekly Market Wrap. And we are one day away from the end of Q1, and Q2 will be upon us in the coming week itself. So we have gone through a week in which U.S. equity continued to slide on the back of new tariff imposed by President Trump on auto and auto parts. And this has been interpreted as being very destructive. And we can see the Wall Street itself has actually reacted quite negatively. Now, this will be a summation of what has been happening for the past week. In fact, we will talk a little bit about what have been transpired in Q1, and we are looking forward to Q2 and whether the sky will be clearer once it goes into Q2. Okay, I have my take, and I'm more than happy to share them with you. So, if you have any question along the way, remember to post them in the Q&A, and I will address them as they pop up. Okay. Now, the format in which we will be doing will be very similar to what we did last week, and it will be a little bit different from what we used to do. And instead of talking about all the other major economic data that will be released throughout the week itself, which can be a bit tedious, I decided to give it to try a different format. Do let me know if you like the new format. In which I will be concentrating purely on the American data alone, and to the extent then what will happen in the second half will be for you to tell me what you want me to talk about instead of me trying to offload everything that I think you want to hear. Okay, so I think this has worked out pretty well last weekend, in which the session actually extended a little bit longer than normal. So again, this is where we are right now. And the usual thing, what we're going to be talking today is not an offer to buy or sell any kind of securities, be it FX, CFDs, crypto, or any kind of margin financial products. Now, do understand the trading of any kind of margin financial products do carry risk of loss. So be aware of your own risk tolerance and your ability to accept the fact that losses is part of trading. Okay. And I'll be sharing you my views later on when you tell me what you want me to talk about as we go through the equity index, then the currencies, as well as the commodities, and finally wrapping up with cryptocurrencies. So those will be my views and my views alone. And again, they are by no means investment advice. And the content of this presentation obviously has not been vetted by any regulatory body. And this is what I want to tell you. And of course, I want to acknowledge the sponsor for this webinar, IronFX, which has been sponsoring my events all this while since last year. And I want to give them a big shout out, and do consider them if you are looking to open a new account anytime soon. Okay, with that out of the way, I want to continue into the data itself. Now, the first data set that came in, I want to move this down a little bit. Okay, the first data set that came in was actually the PMIs. Here we have the simultaneous release of the S&P Global Manufacturing PMI, which stands for Purchasing Managers Index. And this index works the way like this. There is a horizontal red line across the chart itself, and that is the borderline case. Anything above 50 in terms of reading is considered to be economic expansion. Anything below 50, which is the red line that you see across the screen, represents contraction in that particular sector. So like anywhere else, the two main pillars of any economy are, broadly speaking, divided into manufacturing and services. Of course, we all knew America, as much as the UK, has actually been more dominant in terms of their economic output for services, but manufacturing is still a major consideration. Since Trump 1.0, we knew that America has been trying very, very hard to reshore manufacturing back to the United States. The result has been very patchy, but still we want to see how US manufacturing is panning out. So there are two sets of PMI. One is from the S&P Global, but the other more influential one is, of course, the ISM, which will be released this coming week itself. So S&P 500 is just one of them. So as far as this index coming in from the S&P Global infers to tell us that the manufacturing sector has actually deteriorated. Now, remember in February, the number was 52.7, representing expansion. In fact, the manufacturing sector, as far as the S&P Global is concerned, the PMI in the manufacturing has been steadily been climbing since September of last year, and it picked out at last month, in the month of February, at 52.7. So the consensus actually was a little bit negative. They were expecting a climb down from 52.7 to 51.9. However, the number came in a lot worse, and we can see that the number is way below 50 at 49.8. So it is a bad number on top of a poor estimation. So we can see that the manufacturing sector, as far as President Trump is concerned, obviously this will be a concern because he was looking to actually reshore manufacturing back to the United States. And the way he wants to do this is to impose very punitive universal tariff. So far, this is the first full month after he came back into the United States as their 47th president. So we can see that the number has not been what he expected, I suppose. So it is definitely not a good start for him. As far as services is concerned, that is exactly the opposite. Okay, like I said earlier on, U.S. economy is largely a service economy. So obviously, the services sector is the dominant sector here. Here we can see that the number has been climbing strongly, and after a dip from December last year. So we can see that this is again a rebound in their services sector from 51 in February. Market was expecting slightly better at 51.2. It came in a muscular 54.3. So again, services sector is coming back strongly. The last year, the best it ever did was just under 57. So we are definitely seeing the rebound in the services sector in the United States. However, the concern here is the manufacturing. If the next few months manufacturing numbers are showing the same decline as what we are seeing in March, then it shows that the US economy may actually be in a little bit of trouble. Okay, so going forward, this is just a set of numbers to give us an indication or inkling as to whether the US economy is doing A-okay. This is the GDP numbers. Of course, this number has been largely been contested because a lot of people look at those superlative numbers that came in during President Biden's term. Somehow do not believe that those numbers are real. Okay, and whatever the case is, whether we can debate for all we want, the number is the number. Okay, so as far as Q4 is concerned, Q4 actually came in lower at 2.4%. Okay, this is a lot better than what the market has been expecting at 2.3. So 2.3 was the previous two estimates. So the final estimates came in was 2.4. So it's better. But as we compare it to Q3 and Q2 of last year, obviously that has been a little bit worse off. So going into Q4 in the Biden administration, we can see that the Q4 has not been doing as great. And this is where we are right now. Whether this GDP number will pick up in Q1, in the first official Q1 of President Trump's administration remains to be seen. But what we can expect is that the number may not be very pretty, considering the damage done by his flip-flop on his tariff policies. Businesses are confused. They find that it is very disruptive, become plan forward, and consumers are definitely worried about the higher cost of everything else as a result of the tariff, because countries that are at the receiving end of the President Trump's tariff are definitely fighting back. They are retaliating. Countries like Mexico, Canada, EU, and China definitely have different ways of retaliating. But the net effect is that everything else will cost more. By the way, just this past week, Trump has actually passed a new tariff of 25% on auto and auto parts, and this will have a very, very wide impact on the auto sector. Remember, the auto sector is part of the manufacturing sector. Now, the US unions are very militant, and it makes production in US a lot more expensive. So over the years, we can see that some of the auto companies has actually built factories in either Mexico or Canada, and they do send them back for final assembly. So there is a lot of auto parts that has been moving in and out of the borders, either in the south or in the north, and before you get a final products in the auto industry. And that 25% imposition of the tariff would definitely impact the price of automobiles in America. And to make matter worse, President Trump has warned these auto companies not to raise prices. So I think the auto manufacturer will be squeezed between a hard place and a rock. Okay, because on the one hand, they will be subjected to higher input costs because of the tariff. On the other hand, they are not allowed to reflect the true price of their final products. So by and large, you can see going forward into Q1, I think the number will be disappointing. Maybe a number that is way below 2%. Okay, so if that's the case, going forward, this year, 2025, is going to be a little bit difficult to maneuver. Okay. Now, we also look at the core personal consumption expenditure, which is the favorite indicator by the Federal Reserve in terms of measuring inflation. Now, of course, we all know CPI, the Consumer Price Index, is what we know. But as far as the Federal Reserve is concerned, they have put more faith in this set of number. So here we have the core personal consumption expenditure, core meaning to say they have taken out the more volatile component, which is food and energy, to get a sense of where the inflation is heading. And both numbers suggest that inflation is still very much around. Now, in the chart on the left, you have the month-over-month number. You can see that it has been climbing since November of last year, and this is as high as it gets, very, very close to the number for January of 2024. So after 15 months, we are seeing inflation coming back again. And this is definitely not a welcome sign, because if inflation remains elevated, the scope for the Federal Reserve to cut interest rates will be quite limited. In fact, they will be very, very cautious in trying to hike interest rate or cut interest rate further, because any cut of interest rate further in light of the rebound in inflation is definitely going to fuel higher prices going forward. Now, remember, the Federal Reserve has a dual mandate. One is to keep inflation on even keel, and the other one is to promote economic growth. But if inflation remains elevated, as what we are seeing on the month-over-month number, that is not an option for the Federal Reserve, at least for the time being. Now, on the year-over-year number, which is the number that we should be concerned, we'll also see a rebound in the number compared to last month. Last month, it was 2.7%. I'm sorry, this number is actually reflecting last month number. So the 2.7 refers to the January number. So for the month of February, it was 2.8. Again, it is a touch higher than the January of 2025. So again, this is not a welcome sign. But again, this is too early to say that it is categorically speaking, we're going to see higher consumer prices ahead, but it is definitely moving in the wrong direction as far as the Federal Reserve is concerned. Now, remember, Donald Trump has been insisting that the Federal Reserve cut interest rates, and because he wants a lower dollar to be competitive for American manufacturer to be able to compete in the global market. On the other hand, he also wants a strong dollar. Anybody who bypass the global payment system and decide not to use the dollar as the payments currency, he is definitely not happy. So in a sense, President Trump is a bit conflicted, because you can have one or the other. You cannot have both, right? You cannot have a lower interest rates and a lower dollar and a strong dollar all at the same time. Okay, so I think it's a sequence of how things may pan out. Right now, what we are seeing, the fear of recession is actually gaining traction. For the first time, we are hearing the Fed chairman himself talking about the R word, which is recession, and this is also something that he will have to watch. If the US economy starts to slip, okay, by looking at the GDP numbers for Q1, which will be released in the next few weeks, then it will be problematic because on the one hand, we have the core personal consumption expenditure, especially on a month-over-month, showing that inflation is still a problem. And then if you got a GDP for Q1 that slipped from lower than 2.4%, then you have a classic situation in which you have lower economic growth and elevated prices, which means in economic terms that will be classified as a stagflation. Now, stagflation, I've always maintained, is a lot more problematic to actually unwind, because in a economy it is very normal for inflation and recession to intertwine. Okay, however, stagflation is something that is worse off because you have the worst of both cases, in which you have lower economic output and higher prices all around. So that will be a lot more difficult to tackle. So are we looking into what could be possibly a stagflation in the US economy? It's too early to say, but the signs are not good. Okay. So these are the data that came out this past week. Now we are almost at the end of March. Tomorrow, March 31st, will be the last trading day for the month of March, and that officially will conclude Q1 of 2025. Time flies, and so far what we are seeing here is a lot of confusion as far as the tariff policy of this guy over here. And he called April the 2nd. Of course, April 1st is April Fool Day, and he called April 2nd Liberation Day, meaning to say that he feels that once he start to impose all the tariff that he wants to impose, it will bring back manufacturing back to the States. Okay, again, in his mind, that is important, and this is how to do it. Make it so expensive for their trade partners to actually sell stuff to the United States. What he's trying to do, make it so painful that they will decide to move their production line to the United States to produce. Okay, but it is difficult because, for one, we already know the cost of production in the States are very high, and whatever they produce will not be competitive in the global market. But I think that is not his concern. He don't really care how much damage he does. All he wants is for manufacturing to come back. Okay, not all manufacturing will come back. Definitely not the lower end. Okay, the one that he wants to reshore is going to be difficult to actually carry out. Although he's getting commitment from many places, including SoftBank, including the Saudis, and lately the Qatar, that they want to put in hundreds of billions of dollars into the Americas, largely for the AI trend. Okay, but again, those are promises. We do not know whether they will pan out eventually, but let's see. Okay, for the time being, I think the chaos in the market is going to be around for a while as we move into April. Okay. Now, this is the updated chart of the cash index. We can see that the S&P 500, which is the index which most retail investors do participate, has seen a decline. The market peaked out on February the 19th at 6,147.43 in the cash index, and we can see that year to date, the S&P 500 is down 5.11%. Okay, so the rebound that we saw the week before this past week has largely been unwind. Okay, we can see the prices are coming back down again on a month. On a 30 days basis, the S&P 500 has come down by 6.27%. Now, remember, the year to date is measured against 31st December 2024. Okay, so definitely the month number is definitely a lot more volatile. But here what we are seeing here is that the long-term trend remains very bullish for US equity markets. And what we are seeing, the climb down from 6,147.43, which is, by the way, a record high, is part of a normal corrective pullback. Okay, so we cannot classify it as anything else other than a typical corrective pullback. Okay, so understand it as much. Okay, Then in the Nasdaq 100, we are seeing a much deeper pullback. We can see the high was also registered on the same day at 22,222.61 in the cash index, and the pullback has been deeper. And this is understandable because the whole of last year, everything AI has actually taken this index to a much higher high. So the run up into the all-time high has been a lot more pronounced in tech stock compared to the regular growth stocks. So for the for the Nasdaq 100 to pull back a lot deeper than, let's say, the Dow Jones or the S&P 500 is on balance very natural. So year to date is down 8.24%, and on a month-on-month basis is down 7.68%. Again, this is a very bullish market, and the pullback from the all-time high is part of a regular, in my opinion, technical pullback. So will we be facing lower prices in April, or do we going to expect another rebound from here onwards? Later on, when we go into the individual chart, I will be sharing with you my views. Okay. So this is the dollar index now. Of course, this is a basket of US trading partners currency. Ironically, in this basket, there's no RMB, even though the Chinese are the second largest, or rather the biggest trading partner of the United States. This index has been around for quite some time. The currency that has taken up a lion's share of this composition of this index is the euro. So if it is actually seen to be a inverse image of the euro versus the dollar currency pair. Okay, so we can see that overall the dollar is still elevated. Okay, it is still very much a bull market. The high traded at the beginning of the year was 109.53, and since then the dollar has been on the road. It has been coming down, and this may likely to continue for a little while longer. We can see that this index has attempted to rebound 2 weeks from today, 2 weeks ago, but that has largely hit a ceiling somewhat, and prices of the dollar index has been kept. So going forward, there is the possibility the pullback that we see on January the 2nd may extend a little bit lower. The obvious level to watch will be the 100 mark, because this is where the market started to rally in September of last year. Okay, all the way from 100 to 109.53, and now the price of this index is coming back down. So largely, this index is telling us the major currencies are rallying against the dollar. So if you are going to be trading currency pairs, just be aware that the general direction for the dollar right now suggests that it will be seeing perhaps more weakness going forward. Okay. Now this is spot gold. This is the one market that has hoarded the headline. As of Friday, we can see that gold is at an all-time high. Now, this is the spot gold prices. For those who trade gold, do understand that there are two major markets here for gold. One is in London, which trades what we call the local London gold. Now, local is actually a Latin word for delivery. So delivery in London is where all the goods get delivered. Anybody who wants to buy bulk, okay, will head to London for delivery, and that price in on the spot market is currently trading at a discount. Okay, for the reason cited by a lot of analysts, saying that prices in COMEX, which is the other major gold market, is trading at a premium relative to the spot market, and that has been driving a lot of delivery in COMEX. So whether that is still the story for the reason behind the rise in gold remains to be debated. Okay, in my opinion, there are three major factors that is driving gold prices higher. One, obviously, is what we saw last year, a lot of central bank buying, and that is also the result of the Bank of International Settlement, which is sometimes called the central banks or central banks, deciding to reclassify gold from tier 3 to tier 1. Tier 1 is as good as any major currencies. Okay, so we can see that the reclassification of gold from tier 3 to tier 1 now incentivize central banks to actually buy gold and keep them. Now, these gold are not those paper gold that what we are trading on COMEX in New York. These are allocated physical bullion. Okay, so we can see there's a lot of withdrawal of bullion from London to be shipped over to the United States. A lot of people say that is to capture the price difference, but again, that is one of the major factor of the rally in gold prices. Okay, now the other major factors which I can think of course, is right now everything tariff. Now, President Trump's tariff policy is causing a lot of confusion in the marketplace and a lot of fear because his tariffs are very punitive, and the way he does it is that if any country that is a subject of his tariff, if they ever retaliate, will be hit with what he call the reciprocal tariff, meaning to say that if, let's say, for example, the EU retaliate against, let's say, the US tariff on steel and aluminum, then the United States reserve the right to perhaps double, okay, the tariff imposed on that particular country or region. Okay, so if this goes unchecked, at some point the global financial system is going to break, and this is also causing a lot of fear in the marketplace, and this is also one of the reasons I believe behind the surge in gold prices. Now, the other one which I think is even more potent is geopolitics. We know for 3 years the war in Ukraine does not appear to be ending anytime soon. We have attempted to strike a ceasefire between Ukraine and Russia, and between the United States and Russia representative. They met twice in Riyadh, Saudi Arabia, to no success. Okay, so now, as far as we know, the ceasefire talk has broken down, and things are not necessarily looking better. So we also hear that countries, after seeing how President Trump and the United States has actually walked back on to basically disengage themselves from Ukraine by trying to strike a ceasefire deal with Russia directly without the participation of the European, has caused European countries to be very nervous that they can no longer rely on the United States for their security. So there has been a lot of talks and a lot of news about how Europe is going to rearm, meaning to say that they're going to start building their own defense umbrella. Okay, and we are also hearing a lot of news. In fact, a lot of troops build up in countries like Poland, which share a common border with, let's say, Russia. And we're also hearing troop movements in Lithuania, and Germany is at the forefront, whereby they want to open up their wallets to spend for weapon manufacturing. We also hear that France is taking a more militant style, saying that they are prepared to offer Europe their nuclear umbrella. And of course, we also have UK saying that they are prepared to send troops into Ukraine. So all this is telling us that the war in Ukraine may actually be more damaging, and I think there is the possible risk that this war may actually enlarge to involve troops from the European or Western European countries. Okay, if that's the case, there will be one good reason to be buying gold. Okay, then the other thing is that we also know in the Middle East, peace is very elusive. The war between Israel and Hamas has now brought in other actors, including the Houthis from Yemen, and of course the Iranian, who has been supporting the Houthis. So of late, we know that the United States carrier group is in the region, and they have been pounding the targets within Yemen in a bid to flush out the Houthis, and this of course is done in collaboration with the UK. And we also hear news of late that the United States has sent in a second carrier group into the region. On top of that, we also hear news that they are deploying a stealth bomber at the island of Diego Garcia, which is a lot of people were speculating it is either to hit targets in Yemen, or worse, to actually invade Iran. So Iranian have also taken up countermeasures by looking to place missiles at the Gulf of the Straits of Hormuz, which is actually a choke point. So all this is telling us that the geopolitics is going to get very ugly in the months ahead. So we all want to be aware of this. And I think the instrument or the product that people have expressed their fear is in this product called gold. Okay, so going forward, we may see a little bit of weakness in the month of April. Remember, after tomorrow, we have a change of period from March to April. Every time there's a change of period, there's always the risk of people wanting to lock in their profit, okay, for whatever reason. And that could be one reason in which I do suspect that there will be there's very likely to be a corrective pullback. Okay, now if there's going to be one pullback, just do understand those are normal pullback in a very bullish market. So if there's a pullback, take this as an opportunity to actually positions for the next run up in prices. I don't think we have seen the high just yet, but I think a pullback is going to be healthy. And going forward in the next 24 hours, when market reopens tomorrow, it's very likely the momentum behind the all-time high that we saw on Friday may actually extend higher. But going forward, I will be very leery chasing prices as they break all-time high. I'll be more comfortable waiting for a pullback, and then if a pullback happens to be sensible and the price is definitely going to be a lot cheaper than what we are seeing right now. And if such a case actually unfolds, I will be looking to reposition my long position. Okay, so this is the long and short of what I think has been happening so far in the past week. Okay, so this is the segment in which I will invite you to pick the product that you want me to talk about, starting with equity markets. Here we have not only the major equity index from United States. If you want me to talk about, let's say, the European index, such as the DAX or the FTSE 100, or even Asia like Nikkei or the Hang Seng, I'll be more than happy. Let's start with that first. So if you can tell me what you want me to talk about, I will get on it right away. Any suggestion? I'm opening it to the floor so that you have a chance to tell me what you want me to talk about. Anybody want to take the lead? Thank you, Tanvi. Okay, you want me to talk about FTSE, DAX, Nikkei, and the Hang Seng. Okay, so there are four here. Instead of starting with American Equity Index, let's jump into the European Index for a change. For that, I will need to change my slide here to get out of this and to show you this instead. Yes, Jim, I see that you also want me to talk about the Hang Seng. Let's go into DAX, which is the German index. Now, this is very interesting. You know, I've always looked at the European index, especially the DAX, with a little bit of apprehension because the fundamentals are poor, yet the equity markets in Germany are trading at a record high. Okay, but things may be changing because on the monthly chart, I'm beginning to see signs that a top may be in place. Okay, this is the monthly time frame for the German DAX, which is the German equity index. Okay, we can see that the high traded on IronFX platform is 23,474.4, and this has ended. We are only one more trading day away from the end of March. That means to say this bar will end tomorrow after New York close. Okay, so we can see this is a classical reversal. This is a pin bar. For those who want to know the classification of this particular bar here, it is called the shooting star. Okay, and it's of the right color, meaning to say currently where the market closes is below the opening at the beginning of the month. Okay, so if this ends up anywhere like this going into tomorrow's closing, we would have a classical reversal signal, meaning to say that prices are more likely to come down going forward than go up. Okay, so this is the sentiment that I see. But by and large, this is very much a bull market. Okay, there's no sign the market is about to collapse, but I think it's quite healthy for the market to come back from time to time. So this is a good example, okay, of a market that may have seen a temporary high. So going forward, I won't be looking to buy the DAX. If anything, in combination with the poor fundamental, I am more likely to be selling this than selling the, let's say, Asian markets. Okay, so this is one sign. Now, when we look into the weekly time frame, so this is the weekly. Okay, Weekly is not so clear cut. We don't have the classical reversal signal like what we saw in the monthly time frame. So whatever happens going forward in the weeks ahead is likely to see lower prices as this index pullback in a classical technical correction. Okay, so get ready for lower prices in Europe as far as the DAX is concerned. Okay, so I will now go to, let's say, the FTSE, which is the UK equity markets. Here again, we want to go to the monthly time frame. There is no sign. The market is at an all-time high. Fundamentals very much like what we saw in Germany. They are poor. Okay. In fact, the UK has likely already slipped into recession. So the high here is 8,909.2 on the IronFX MT4 platform. We can see that this is not a classical reversal signal here. Okay, but we will want to continue to watch how it closes by tomorrow. And end of day. Okay, if this end up to be lower than the low of last month, then it will be a different story altogether. This month we saw that the prices, as far as we can see, has actually went lower than previous month, which is the month of February. But currently, where the market closed at 8,640, is not conclusive enough to tell me that the market is seeing a temporary top. Okay, so for this, I'm not seeing the same classical reversal signal that we are seeing in the DAX. Are we going to, but at least we can see that there is a counter trend now in place at the using the weekly time frame. Okay, so based on the weekly time frame, if you want to take a chance to trade counter trend, you could do that. Okay, especially so if the market rebound back into the 8,820 levels, which is this dark pink area here. This is an area where, if you want to trade counter trend, the risk reward actually is very attractive. Okay, so if you sell anywhere within this area here, put a stop just above this all-time high here, then all you want is for the price to go lower below this low that we saw here at 8,496. If the market can go below this level, then the target will be at 8,241. So it's actually quite a superior risk reward ratio, risking no more than, let's say, 30 points in expectation of a drop back to 8,240. Okay, so based on this alone, it is quite attractive. Okay, so again, it's an individual selection. Okay, so now that I'm done with this as well, give you my opinion. Let's go into Nikkei 225. Okay, Nikkei, of course, is understood to be the Japanese premier equity markets index. Here we have the monthly time frame. Now, for a long time now, the high traded here at 42,484. This is the all-time high. We have not seen prices like this for decades. Okay, so last year, during July, we saw the Nikkei 225 actually surged to fresh all-time high for the first time in decades. But we also saw the market pull back very deeply from 42,000, almost 500, all the way down to 30,400 and lower. Okay, but that was accompanied by a very aggressive rally. Okay, resulting in a very strong move here. Now, this is a classical bullish signal. Okay, so prices since has not been able to stay meaningfully above 40,000. The best it did was 3 months ago in January at 40,508 on the IronFX MT4 platform. Since then, prices has not been able to hold on. So right now, where prices close on Friday, okay, this is the lowest close that we have seen since when? Since February of 2024. So let it sink in a little bit. Closing prices on Friday, okay, is the lowest we have seen since February of 2024. So by tomorrow, when the Nikkei closes is way below, that means to say the market is getting ready to correct. Okay, so if the market corrects, we can see lower prices. For the time being, we can see that the higher time frame dominant trend remains very bullish. Okay, so will the market revisit this low here that we saw back in back in August last year at 30,379? It all depends, because this by itself is a very strong reversal suggesting higher prices. But try as it may, for 4 months in a row, market did have trouble getting above 40,000. So this now has resulted in disappointment, and people are getting out. Okay, so if this is the trend, over time we will see how this thing unfolds. Okay, unless the low here 30,379 is taken out, okay, I'm still going to say that at some point this market may rally again. Okay, so this is not possibly the best place to be in going forward. Okay, I won't want to be selling this uh, because there are other better places to put my money. Okay, because this bar alone changes the overall structure of this pullback. So given a choice, I would not want to be selling this in a fresh position. In the weekly time frame, you can see that there's a bunch of prices consolidating here. So now this bunch of prices just under 40,000 is going to be a major barrier to higher prices. Okay. Here again, what we saw on the weekly time frame is very similar to what we see on the monthly time frame. This low here at 30,397 has resulted in a reversal pattern. So again, this will be the key. Will market take out this level? If it does, then of course we are in a different pattern altogether. Okay, but the key level to take out will be this level 30,259 in this MT4 pricing on based on the IronFX pricing. Okay, so if you can avoid trading the Nikkei, maybe it's best to do so. Okay, now let's take a look at the Hang Seng. The Hang Seng has been doing very well since last year. Okay, the market has been in a long-term bear market, and it is still in a bear market. Okay, in the long term, you can see that the high at 33,360 has resulted in price going all the way down here, and now it has bounced. Now the bounce last year is still ongoing, and it is so far a three-wave affair. How I know it? Because this is the 1.236 percent of the initial leg of this rebound. So it is very much a three-wave corrective bounce. So if that is the case, then maybe we are getting ready for lower prices. Means to say that this bounce has ended potentially at the high here at 34,900 in the Hang Seng. This is based on the monthly time frame, and if I'm right, then we could be seeing lower prices ahead. Because the overall trend is still down, this bounce that we saw, unfortunately, it's only three-wave. So if it's three-wave, this is a classical technical rebound. Nothing more than that, okay? Unless the prices starts to rally aggressively. Right now, we are not seeing that. So on the weekly time frame, the market has hit a pocket of prices. Remember this darkened pink area is what we call the very deep retracements. The dominant trend is down. So if market gets into this bracket of prices highlighted by this darkened pink area, which is anywhere between 24,920 to 26,769.7. So the price actually brushed into this area here only once. Okay, that is on that is the week before this past week. The high trader was 24,000.5. Okay, and since then the prices has come back down. So it is very obvious this area here has a lot of selling interest because this is technically as perfect as it gets, because this is 123.6% bounce. Okay, so if you are a technical trader, when you look at this, coupled with the fact that prices struggle within this very deep retracement area, then obviously it favors this to take profit on this rally. Okay, now Hang Seng has been doing well on the back of all these AI talks. Now remember last year, all the AI has been concentrated on American tech companies, but this year the picture has changed ever since DeepSeek came out with their AI model, which suggests that they can do the same thing with less. It has basically broken the business model for a lot of AI companies in the States. So anything AI now has shifted to China, and the Hang Seng market has actually benefited to a large extent, okay, on this talk about DeepSeek. Of course, now we have seen many AI companies in China are also releasing their AI models in an open source model, meaning to say they are free to access, and that has basically damaged the business model for a lot of American AI companies. So here, technically speaking, the market may have hit a temporary top, and going forward, the risk is to the downside. Right. So I have covered the Nikkei and the Hang Seng. Let's go back and see what else you want me to talk about. Tandy, no worries. We can do the American one as well, please. Okay, Lily is asking, how do we see Hong Kong market? I've just mentioned that it's retracement coming down, and in my opinion, with bullish 2.5 months, how long this retracement might likely take place. My thought is this: because on the higher time frame, such as the monthly time frame, the market has rebound in a classical three-wave equality move, and the market having only brushed at the very deep retracement on the weekly time frame at 24,500 is telling me market right now in the Hang Seng is very technical. Okay, so give more consideration to the technical outlook rather than the fundamental here, because whenever the market hit a key level, whether you are doing it as a Fibonacci extension of or any kind of other metrics, then I will consider that to be what correct a technical market. Right now, the Hang Seng is quite technical in a sense. So if the market has reacted by pulling back from 24,500, it shows me that there's a possibility the rebound that we saw last year may have ended in a very classic three-wave bounce. Okay, going forward, lower prices is definitely in the cut, especially if the other market starts to unravel, whether it is the European or whether it is the Wall Street itself, then the sentiment will not be supportive of higher prices in the Hang Seng. So that is my 2 cents worth. Hopefully that will be enough for you. Okay, let me see what else is being asked of me. Okay, nobody has anything else you want to ask me? Anything else? Okay, the fact that nobody asked about Wall Street, let me go back to, let's say, the Dow Jones, S&P 500, and the National 100, just to wrap up the equity index. Okay, here we have the Dow Jones on the monthly basis. Okay, now the market has obviously been capped at 45,000 thereabout. Now, based on the MT4 trading platform from IronFX, 45,000 thereabout seems to be a heavy resistance, because for 4 months consecutively, we can see the market has actually tried to take out this level, and on all 4 occasions, it results in a pullback. And this month itself, we can see March see prices coming off rather aggressively. Where the market closed last Friday is the lowest we have ever seen this index since September of last year. So again, take that into perspective. Market has rallied into all-time high. Now remember, the Dow Jones is actually used or rather tracked by the money managers, the fund managers. So this one reflects more international fund playing this index rather than retail. Okay, so here we can see that the divergence between the performance of the equity market in the States relative to the rest of the world, we can see that Wall Street is underperforming, which is a direct opposite of what the Wall Street has been doing going into 2025. Okay, so other places in other equity markets, including Singapore, is doing a lot better on a percentage basis compared to Wall Street. So here we can see that Wall Street prices are diverging from the global markets here. So Dow Jones is telling us on the monthly time frame, the international money flow seems to be wanting to get out of US and maybe to reposition their funds elsewhere. Okay, so we do not know going forward into April itself. I do have apprehension going forward. So far, the pullback has been again three-wave, classical. Okay, the top is 45,078. Market went down, bounced back up, failed to take out the all-time high, come back down in the three-wave. So now it is three-wave. If it's three-wave, then market could be getting ready to rally, to resume its rally. But going into April and May, I'm not so sure. Okay, because of all this movement in gold is telling me that market is more concerned about the geopolitics and not so much on anything else. So if that is going to be a representation of fear by investors, then you do not want to be on the risk on. You want to be on the risk off. Risk off means you will park your money into asset, okay, that actually do not require you to take a lot of risk. Okay, we call risk off markets. So equity markets are risk on. So if the fear represented by the rally in gold is any indication, then I think the market may be taking a risk off attitude rather than a full on risk on. Okay, so going forward, although we see a three wave, but this three wave could actually accelerate to the downside. If, for example, the Dow Jones, okay, accelerate below 35,000, 39,000, that will be a different story altogether, because so far it's three wave. But if they accelerate below this line here, which is represented at 39,300 thereabout, then it will be a different story. It could potentially be a five wave, 1, 2, 3, which is very, very deep, followed by a bounce, followed by another down. Okay, so that will be a different story altogether. Okay, but for now, it is a three wave equality move. Again, very similar. We have a 123.6%. Okay, pullback so far. So this is the weekly time frame. Let me go into the S&P 500, which is where everybody is concentrating right now. At least the retail is concentrating right now. Okay, so we can see that last month, in the month of February, the market went to all-time high, peaks out at 6,147.2, and this month we have a slam down. This sell-off is a little bit aggressive. Okay, last month we have what we call a doji. Now, let me expand this for you. A doji is where the market opens and closes very, very close to the opening. Okay, so we have very little body here, but we have, a long wick to the top and a long wick at the bottom, resulting into a doji. A doji is basically telling us the market is unsure. After taking the market to all-time high, it was not followed through, and in fact, the market has actually come back down. And going into last month, you can see the market took out a marginal high compared to January. Okay, with a marginal high, market starts to pull back down. This looks like a classical fake move. Okay, meaning to say that it has lured the buyers into the market. For those who buy breakout, then there is very likely there will be buyers that are stuck at all-time high. And then when the market pull back down, these people who bought now are trapped. We call a bull trap. Okay, so going forward, this S&P 500 representing retail investors, this is classic because the last guy to get in any kind of major trend is always the retail investors. Prices has broke into an all-time high without a similar move in the Dow Jones, which is an index followed by the fund managers, so-called expert. Okay, so retail investors have got in to buy the high. Now the prices follow subsequently by a deep pullback in prices. This looks like a classical bull trap. So the retail investors are most likely trapped here. And this one has the potential to go a lot deeper, because for those who have bought the high, they will fight this market thinking that if the market recovers a little bit, maybe they will cut some losses. But if the market does not give them the chance, market accelerate to the downside, okay, they may be looking at ruinous loss going forward. So be very careful with the S&P 500 because I believe the retail are all stuck at the top. Okay, so this is the monthly time frame. Let's take a look at the weekly. Now, weekly, we can see over the last 6 weeks, okay, out of the 6 weeks, there's only one positive week, which is the week before last, okay, and this week itself, we can see prices coming back down. Will it go down below 5503.9? I think the odds are very good. This low here looks looks like it will be taken up. So the nearest support is somewhere around here, anywhere between 5,089.3 to 4,925.6. So anywhere between these 2 points, that is the area where the last support seems to be congregating. Okay, this area may be where the market may be heading up. This area, okay, between the swing low here and swing low here. So this market is very close to my projected target here at 5,100. So going forward, I think there's a good chance we will see a follow-through fall in the S&P 500 in the month of April. Now, next one I will look at will be the Nasdaq 100. Now, remember earlier on, I've shown you how the Nasdaq has been the worst performer so far this year on Wall Street among the major equity index. Now, if you see last month, the market has a brand new high. Again, the market has a marginal high compared to December and quickly come back down. Also very much like a doji. So again, the same story for the S&P 500. The people who bought the high on breakouts now are stuck at the top. So this is followed by quite a sharp decline in the index here in the Nasdaq 100, potentially locking in all these people who bought here. Okay, psychologically speaking, these people will be unlikely to cut loss until they are forced to cut loss. Okay, they may be telling themselves the market rebound, I will take some losses and be out of the market. But there's a very good chance if the market continues to slide very aggressively, they will have no choice but to hang on and hope for the best. So based on this, we can see that the nearest demand is at 17,238.8, represented by the swing low here that we saw in August of last year. Okay, so very near to this, there's also nearby support here. So based on the swing low that we see, it's very likely that demand is above here. Okay, this could be where the demand is. And it's also very near to my target of 17,179. Okay, so hopefully this one, it all depends. If the market accelerates to the downside, hit this point first, expect a bounce before another leg down. Okay, so this would, if this is the outcome, then we may be likely seeing a couple of weeks of weak prices. Okay, and let's take a look at the weekly. Very similar to the S&P 500 over the last 6 weeks, there's only one so-called positive week, okay? And for the last 6 weeks, it has been all negative. Where the market is right now, this is the closing. Based on this, we can see that this is about the weakest closing since September last year, okay? Not a good picture. If there's going to be a change of structure, for example, right now the dominant trend is still up on a weekly time frame. If there's going to be among the 3 major equity index on Wall Street, the first one to show a change in structure could be the Nasdaq 100. Because to break this level here at 16,969.6 is a lot easier to be achieved in the Nasdaq 100 rather than, let's say, the Dow Jones. Okay, so if there's going to be a change, that means to say that if the market goes below this level of 16,969.8, then I will have to remove all these green boxes and keeping only the pink, which tells me the trend has changed to the downside. Okay, so this will be my bellwether now, right now. Okay, I'm done with the equity index for both United States and Europe and Asia. Anonymous is asking, please talk about level for gold. I will go to gold on the later on, okay, when we are looking at commodities. Lily is asking, how do I see Bursa? Will it further correct again following the weak US market? I have a chance to briefly look at the KLCI. Maybe I will do that for you. I will change into trading view just to give you an idea. So right now I'm showing you the trading view, and let me go down to Bursa, KLCI. Let me know if you can see my chart on trading view. Okay, this is the futures. Can you see what I am putting on trading view? Type yes if you can see it. Thank you very much, Jim. Okay, this is the futures contract traded on the Bursa Malaysia, which is the KLCI futures. Okay, this is the daily time frame. The market peaks out last year, okay, in August at 1,691.5, and the market has turned bearish unfortunately. Last year, we knew the Bursa has done very, very well, but the market picks out at 1,691.5, and the dominant trend now is suggesting that we are seeing lower prices ahead. So the Bursa picked out months before the Wall Street itself. So we have a bit of a bounce from the low here, okay, at 1,465.5. Now this low here is actually on middle of March, okay, and it's unfolding as a three wave. Can you see the three wave rally? And if I have to do a projection, I take the low here, take to the high here, put the low here. Okay, let me arrange this. I want to show this and show this. Okay, so there is this blue area here. So the rebound from 1,465.5, if it unfolds as a classical three-wave bounce, is likely to hit this pocket where the blue area is highlighted. Meaning to say is the area here is 1,549 to 1,960, okay, there about 63.5. So at best, you can see that this is a bounce of a trend now that has flipped to the downside. So if the market managed to crawl its way back into this blue area here, then I think we want to be realistic about the prospect of higher prices. I think there's every possibility the seller will re-emerge in this area. And if that's the case, this low here that we see at 1,465.5, okay, which was last traded on March 13, will be revisited and be exceeded. So this is my take on the KLCI. Since we're on KLCI, I also want to show you what I saw earlier on when I take a look at the Straits Times. Straits Times is on fire. This is a very bullish setup. For some reason, the Singapore market has been very strong. Okay, the high traded at 4,005.18 was registered on Friday, and it closed on a weak note. This is not a good sign. Okay, when the market goes and take out a round number like 4,000, okay, and then close on a weak note, is never a good sign. Okay, so but from the look of it, the market here in Singapore looks to be relatively strong, stronger than Bursa, stronger than Wall Street. Maybe that's in line with what we saw in Europe. Okay, so maybe the Singapore market is mimicking what we are seeing in continental Europe. All right, I don't want to digress too much. Here, anonymous, how would I confirm that Hang Seng has turned bullish in long term? It has not. I did not mention that the Hang Seng has turned bullish. I'm saying that the rebound that we saw in the Hang Seng has unfolded in a three-wave rally, which has the potential to pick up. And going forward, we may be seeing the resumption of the larger bear market. I did not say Hang Seng has turned bullish. I have not. Okay. I want to repeat again, the rebound that we saw in Hang Seng from last year could potentially have ended with the recent high that we see. Okay, and if that's the case, it's logical to therefore conclude the resumption of the bear market is upon us, potentially. Okay. All right. I'm done with equity markets. Let's move on to commodities. For that, I have to shift you back to the platform itself, the MT4 platform. Okay, now we talk about the currencies. Anybody want to talk about currencies? I will start off with the euro versus the dollar. Earlier on in the dollar index chart, I did mention that the dollar looks like it is resuming its downtrend, and that should logically means we should see a corresponding rebound in the major currencies, including the euro dollar. So euro dollar had a very strong month so far. Okay, the rebound started at the 1.017, and it has closed at 1.0826. So there is a possibility this will end up as a three wave. And if it is a three wave on the monthly time frame, there's a possibility market may be gunning for 1.19 to as high as 1.23. I have a target about 1.20 half. So that is also very much in line with this swing high here, 1.23 half. So going forward, if the dollar continue to weaken, which is suggested by what I see on the dollar index, then all corresponding major currencies should actually benefit from the weakness in the dollar for the time being. So suggesting in the euro versus the dollar, we may be seeing a little bit more upside. Okay, hopefully we will see a continuous rally beyond the 1.1275. So this is the monthly time frame. Let's take a look at one degree lower. On Tuesday, we have a major run up, okay, in prices. Okay, so prices, if you look at this three wave, is gunning from 1.19 at the bare minimum. This will be symmetrical, right? So there's every possibility we will see extended rally in the currencies. And that being said, let's take a look at the sterling, which is another major currency pair over here. So again, when we look at this, I want to refer to the higher time frame, which is the monthly time frame. What we are seeing here, that a bounce from 1.036, okay, it's not unfolding as a classical three-way. It's not very, very neat, okay, but there is the possibility of a resistance anywhere inside here, which is for one. This one is 1.42475. Okay, and another over here, which is this bar here. So I think the best we can expect from a sterling move is a revisit of this level, 43764. Okay. So if this result in an extended rally beyond 1.3434, the next logical area which the market may gun for will be here. These two levels. Okay. Somewhere between these two swing high could be where the market may be gravitating towards. Okay. And then in the weekly time frame, do we see confirmation of that? I think yeah, the last 2 weeks has been strong, very strong. Okay, the market bounced off this area here, which is again a very deep retracement. So it give the incentive to actually trade counter trend. The dominant trend is down, so this is part of the rebound that we are seeing in the higher time frame, and this is coming off 1.21. If you didn't buy here, you miss it altogether. Okay, so this is sterling. Anything else that you want me to talk about? I have not checked my Q&A. Oh, you mean to say that what sign I will look for in Hang Seng for bullish turn? It got to be a technical. Right now, the market in Hang Seng is moving very much in a technical manner. Okay, so I need to see technical reversals. So unless I see a reversal in the price chart, I'm unlikely to see to want to go long on Hang Seng right now. Okay, and as further into currencies, let's take a look at the dollar versus the yen, which is a major currency pair here. Monthly time frame, you can see that the market peaks out last year at just under 162, dropped to 139.58, bounced back to 158.88, and now for 3 months in a row we are seeing lower prices. This could result in a three wave, okay, targeting anywhere between 131 to 136 and a half. So this area here. So by and large, unlike the very bearish outlook for dollar index, the dollar yen is actually quite bullish. Okay, dollar index is bearish, at least for now, but we can see that the dollar yen is actually in favor of dollar strength. That means to say we probably will see further weakness in the yen. Okay, unless of course the Bank of Japan starts to hike interest rate aggressively, that may change the picture. So far, the Bank of Japan has been hinting that they will continue to look to hike rates so long as inflation is elevated. Okay, so we want to see how that is going. Okay, so if you're going to be technical about dollar yen, if ever dollar yen pulls back to anywhere 136, that could be a buying area because largely the trend suggests higher prices ahead. This is the weekly. This three-way pullback is a lot more prominent right now. Okay, Friday end up weak. There's a possibility this coming a month itself we will see lower prices in dollar yen. Ideally, go into this bracket of prices anywhere between 131 to 126 and a half. Okay, this blue area is actually a great area to pick up dollar versus the yen, meaning to say buy dollar and sell yen. Okay, because overall we can see from the monthly time frame the dollar yen is bullish. In the weekly time frame, it is bullish until this level is taken up at 126.36. So the closer we are into this point of no return is better. Let me check questions, see if there's anybody else having new question. Dollar Swiss. Yes, I will be talking about dollar Swiss after this. How do I see the Swiss market as compared with the European markets? I have not tracked the Swiss market. I cannot honestly give you an answer offhand. Maybe I can add the Swiss index and cover that maybe in the weeks ahead. Okay, let's talk about dollar Swiss, which is also a major currency pair, but not as widely traded. Here we can see that the dominant trend is down because the bigger box is pink. This is the monthly time frame. So by and large, the dollar weakness is more evident in dollar Swiss rather than dollar yen. Dollar yen overall, technically speaking, is bullish. Dollar Swiss, on the other hand, is the exact opposite. Okay, so we can see the market has gone into a sideways consolidation for quite some time. It is still within the consolidation period. Okay, the market top is about 130, 103 half, and the lowest traded is 83 cents. So between these two extreme point, the market is consolidating. So if based on this, I would not want to touch this currency pair because there's no profit if I get my money stuck in a sideways market. Or rather, it trends aggressively either way. Okay, but here I can see that in the higher time frame, the monthly time frame, the market is in a sideways consolidation. So it take away the incentive for me to even look at it. Okay, I will monitor it, but I may not trade it. You can see that the market has been kept just around 92 cents, right? 92.24, 92.01. So top side here is about 92 cents. And if that's the case, market will revisit the lower end anywhere between 83 cents to 84 cents. Okay, no incentive. Let's cover another one, another currency pair. Let's talk about dollar Canadian. Okay, this is the monthly time frame. The market has picked up. Now this is very interesting. The market top here going into the high here at 1.4793. Previous high here was 1.4690 thereabout, followed by another attempt here 1.4667. So here we have 1.47, 1.4794, and the market seems to be struggling. It did not even hit my target. It was just shy of the target before I pulled back down. But by and large, this market is strong. So again, now we have two markets that suggest the overall trend in the dollar is bullish. So be very careful selling the dollar if you if you're looking to hold, okay? Because the underlying strength in the dollar is very evident in the dollar index, is very evident in the dollar yen, and definitely very evident in the dollar Canadian. Okay, so do not try to sell dollar unless you are just doing short-term trading. Okay, if I'm going to be holding, I want to be holding dollar, not the other major currencies. Okay, so this is the monthly time frame. Let me take a look at the weekly. We have a big sell-off from the top here, 147.94, big sell-off, and then the market consolidate. So if this is going to be what it looks like, assuming the bounce here ends at 145.43, then lower prices is more likely to be the case. And the low here that we saw at 141.51 is most likely to be taken out in the next wave of selling. Okay, so yeah, the overall trend in the dollar remains very bullish, but based on the pattern that we see, this pattern is starting to see a resumption of the pullback. It will target anywhere between 139 to 137 half. Okay, between these two areas. Right. Any other market? Okay, well, let's talk about Aussie dollars. I know some of you do watch the Aussie markets. Now, the Aussie market is among the weakest among the dollar pair, okay, where euro dollar has bounced, sterling has bounced. The Aussie bounce is very tentative, okay. In fact, it's not even strong, if I may conclude, okay. The low traded so far is 61 cents, 0.60887, okay. Very, very weak. But by and large, it should resolve to the upside. Three wave, right? Three wave is a classical move. Now, assuming the low that we saw the month before, okay, is going to be that low, then what we can see here, if I do a three wave, hang on. I want to do this. Expansion from the low here, the high here. I'm pulling this back here to the low here. If this is going to be the case, there's a very good chance market may actually take out this higher towards 0.86, 86 cents, which will resolve in a three-wave move. Okay, the dominant trend is down, so this could be part of that bounce. But among the major currency pair, the Aussie seems to be the weakest. It doesn't exhibit strength. So not sure whether that will be a good currency to be trading if you are looking to catch the rebound in the major currencies. Okay, but at least for now, there is the possibility of a move here. If the market, let me see, expand this a little bit. If the market can go back down here into this blue area, that will be a good area to pick up some more long because the risk will be quite low. So right now, whether this will be the case remains to be seen, but if it ever come, it could be one good area to actually catch this move. Let me move myself away from this and show you the levels. That will be somewhere 0.6088 to 0.6156, which is this blue area here. If this result in this move here, this could be a good area to pick up some more long position and then keep a tight stop below this low here, hoping the market will, from here onwards, result in a catch up with the other major currency rebound. Let's take a look at the Kiwi market, which I don't trade very much. Very similar to what we see in the Aussie, is pretty weak, okay? But so far we have seen there is a bit of demand at the lower end, especially inside this box here. This box here bordered by 0.49 to 0.548. Okay, seems to be a good area to pick up some long position. So far it has held, okay, but the structure does not suggest strength very much like what we see in the Aussie. So in the weekly time frame, not seeing sign at all. Market did dip into this area in a three-wave pullback into this blue area, and then starting to bounce. But the bounce here has no strength, very little conviction here. So if you have no faith in the bounce in the Aussie and the Kiwi, maybe you want to put your money in the other major pairs like Euro or Sterling. Okay, I'm out with currency unless you want me to talk about another currency. Is there any? Let me take a look at your question. No, okay. Now let's move on to commodities. I want to talk about crude oil right now. Now, crude oil is very tentative, but we're beginning to see a bit of stirring, okay? Meaning to say that the bounce in the oil market since the low in the pandemic is still very much with us, okay? Market did rally to a high of $126.47 in the early days of the war in Ukraine, but since then the prices has come back down and the market has been holding very well above $64 per barrel. Now remember, this is the blue area on a highly on the monthly time frame, so this is a very, very strong area of demand. Prices has gone down at the beginning of the week of the month to test the $65. Lowest traded was $64.99, but now the market is coming back up again. Okay, in fact, this month the high traded was $70.37. It did not quite hold on above $70, but I think things can change, especially if we have an escalation in the war, let's say in the Middle East. If for whatever reason the US decide to strike Iran, okay, this will be a very bullish development, okay, for crude oil. After all, Iran is the third largest producer of crude oil. Okay, so just based on that fundamental, if there's going to be any strike on Iran, it will definitely cause a spike in energy products, including the WTI, which is the West Texas Intermediate Crude. So for the time being, it's tentative, but it's looking good, honestly. Weekly time frame, the market is holding out very well. You can see this is the $64.75, $64.08 market. This traded into this area again this week. On Tuesday, it was just under $65. Then again on Wednesday, it managed a higher low at $65.04. Everything screamed I should be looking to reestablish my long. Okay, so not sure whether I will do it in the coming days, but I think it is looking to be quite attractive. Okay, all I need is a catalyst, and the catalyst could come from Iran. All right, gold. This is going to be interesting. Gold to me is running away. Okay, this is the outlook for gold. It is so bullish, it closed at the high of the move. The high traded was $3,086.79 on the spot market as quoted by the MT4 on IronFX platform. Okay, this almost guarantee that the market will open high tomorrow. Okay, maybe open with a gap, which is incidentally what I saw on the futures market. So when you trade gold, it will pay to actually monitor the COMEX gold, okay? Because COMEX gold is more speculative and the pattern is definitely more reliable. So what I do see is that there is a gap that opens up on the way to an all-time high. Now remember, gold this year has been phenomenal. Since the start of the year till last Friday, gold has appreciated like something like 38.3%. This is more than its entire gain from last year. Last year, I believe gold as a whole has rose 24.7%. So this year, oh no, 27.4%, somewhere around those numbers. But this year, we can see with only 3 months of trading, gold has already gained 38.3%. So this market right now has all the ingredients to actually charge higher. And this is also where the risk is at the highest. Remember the change of period from March to April. Whenever you have a change of period, it's always to me a very dicey period to continue to chase the trend. So prices are most likely to continue to extend higher, but I'm not going to be buying. Okay. In fact, I will, if I'm already long, which I'm not, then I will be very happy to consider level to exit. Then to reposition the long, because the market is basically very, very bullish, okay, to position my long at a lower level, ideally within the green color box, okay? So that means I'll need to see prices of gold coming back below $3,000 per ounce. But right now, there is no sign that it's coming back down just yet. It may happen in the weeks ahead, maybe as early as next week, okay, in the coming week, especially if the market charged into new high, and then if we see a similar move like what we saw in the S&P 500, where we have a classical reversal signal like what we saw in the DAX, for example, that will be my cue to go in and take profit if I'm long. And then if I'm going to be trading counter trend, I'll be very selective, okay? Because any pullback is likely to not last beyond, let's say, end of April, okay? So that with that in mind, I am not chasing this market higher, but I'm not selling just yet. Okay, if I'm selling, I'm going to reduce my exposure by half of what I normally do for buying. Okay, so just be a little bit a bit more savvy. In the weekly time frame, there is no sign this market is coming down. In fact, it is pointing very heavily to the upside. Here I have made a note. So look for a panic cycle. This panic cycle refers to a major run up in price. Okay, so if we have a pullback, that will be all well and good. If we have a pullback in April, then I'm going to position for the next run up in May. But if the market continues to extend higher, okay, all the way into end of April, then I'm not looking for pullback. Then this panic cycle could refers to a massive sell-off. But I doubt so, because May is a very, very critical period. I do see an escalation in the geopolitics, either in Ukraine or in the Middle East. That should be conducive for precious metals. Okay, right. I will be talking about silver now. Silver has been lagging so far behind. I think it's time for it to catch up. It is not as bullish as gold, okay, because it has not gone back to above $50 per ounce, okay. Eventually, this high will be taken out. I'm very sure of that. But right now, the structure suggests that it is not very convincing. But based on the closing price on Friday is the highest we have ever seen. Since when? Since October of 2012. That's 13 years high. Okay, so yeah, it may be lagging behind gold, but it is also looking to go higher. Hopefully, when the correction comes in gold, it will allow silver to pull back to a more sensible level. So because silver has been lagging so far behind gold, maybe we want to have exposure in both as well. Okay. Look at the weekly. Okay, this is interesting. Prices of silver on the weekly time frame in the spot market has now traded into this area, which is highlighted as the very deep retracement levels. Now, the fact the market is trading inside this sensitive area does give a little bit of bias to the downside, but right now we are not seeing sign that it is about to come off just yet. Maybe if there's going to be a more pronounced correction in gold, maybe then we will see a corresponding pullback in silver prices. Right now, this market is looking interesting. Maybe I go down one time frame lower, look at a daily. Unfortunately, daily do not have a counter trend just yet, and there's no indication the price is going to come back down just yet. I need to see a counter trend in place, followed by a bounce. Right now, it's not even there yet. So again, no opportunity in silver, but I'm very, very leery chasing gold ever higher. Let's see if there's any more question from you guys. All right, Lily is asking, okay. Oh, Dennis, I've already shown you the gold and silver. Let me address this from Lily. When the gold is bullish during the uncertainty period, how about metal ETF, which might include silver and other precious metals? Now, ETF for precious metal, you have to understand one thing. Both precious metals for silver and gold are heavily manipulated, especially in COMEX. Okay, so I'm beginning to see people thinking delivery. In fact, the delivery for the February contract for gold is so high. I have never seen such high deliveries in COMEX. Now, COMEX is a pure speculative market. People once delivery, they go London, they don't go New York. Okay, but the fact is that there's so much repatriation of gold from London to New York. Okay, and you got to understand that people like JP Morgan and HSBC, these are big bullion banks which also own the SLV, which is the silver ETF, and GLD, which is the gold ETF. I suspect they are taking delivery through the ETF. Okay, and I'm not sure for who lah. Okay, but there's so many moving parts. For one, we know that there is that talk about trying to audit thought not. Nobody knows whether the gold are still there. For some reason, nobody's talking about that anymore. And it coincides with this major shift in taking delivery in London to be shipped to New York. So not sure. Okay. But as a trader, I'm not going to touch the metal ETF with a 10-foot pole, because theoretically, if you want delivery, you can have it, but it is not for everybody. Okay, I think ETF is basically a game played by the big boys. Okay, so you and me, I don't think we should be getting involved in metals ETF. Okay, yes, you can take a look at the miners. Okay, but ETF, I'm not sure. I'm really not sure. Okay, all right, I'm done with precious metal. The last bit I will talk about is crypto. Let's take a look at Bitcoin. Now, Bitcoin has been underperforming. It has been sliding, but not in a big way. We can see that the high traded at 109,567. Okay, no, sorry, 109,567,000. Okay, prices went down to as low this month to as low as 76,500, thereabout. Okay, here we can see that Bitcoin is struggling, but it is a very bullish market. This is not a bear. This is a pure bull. Okay, and although we see a bit of a decline of late, okay, but overall this market is very bullish. Okay, I even put here the bull market may extend all the way to 2029. So I'm very long-term bullish on Bitcoin. Okay, let's see what happens. We have a bit of pullback in this month. You see that I say here a pullback into March. So we are on the tail end of March. Tomorrow marks the end of March. So my thinking is this: if we don't see further decay in prices, I think the low that we saw in this month in March could actually be a base for the market to launch higher. Okay. So let's see what happens. Technically, I think the market has pulled back. It did not accelerate. Okay. Now we don't see that. There's no sign the market has found a bottom just yet, but I suspect that it's anytime now. Okay. In the weekly time frame, we have a bit of a consolidation looking at this bar here. 3 weeks ago, market hit a low of 76,000, almost 600. Okay, and then it stabilized. This week has not been great, but it managed a 3-week high, which is something, right? So going forward, I will let the market tell me it's because it has unfolded 3-wave in the weekly time frame and into equality. This 3-wave is almost symmetrical, followed by this bar here. So I am a little bit cautiously bullish on digital assets led by Bitcoin. Okay, this is my 2 cents worth. When I look at the other, let's say for example, Ethereum is not performing as well. It is still trying to find a bottom. So this is Ethereum. The 3-wave pullback is not complete. So the only downside on the very cautious bullish outlook on Bitcoin, we will have to take it with a pinch of salt because this pattern has not finished. If this pattern finished, it will take out this low here at $885 and into this blue box. And then by then, it will look very, very interesting for me. Okay. So far, Ethereum has been underperforming. So either we wait for Ethereum to finish its pattern or we just stay away from crypto for now. Okay. Prices are now heading, I think by tomorrow, we'll probably see a low lower than Friday, which is $1,753.81. All right. The one that has come off quite a fair bit is actually Ripple. But Ripple is also getting very interesting. I've always been bullish on Ripple. I have yet to position anything in Ripple just yet. So far, there is no. This is on the monthly time frame. This is an inside bar. You see, last month we have a high and a low. You can see this month here, the high here is lower than the previous month high, but the low is also higher than the previous month low. So let's make it technically an inside bar. So it will have to take a little while to resolve itself. Based on the monthly time frame, I cannot see any sign that the market is about to find a bottom or it's about getting ready to rally. But I'm always on the lookout for this one because I'm very, very bullish on Ripple as because the story behind Ripple is a lot more meaty compared to, let's say, building a strategic Bitcoin reserve like what Donald Trump wants to do. Here we can see that the weekly time frame, yep, it is still struggling. So in the sense, if this is going to be the pattern, it looks very similar to what to expect uh, for for Ethereum. Okay, if this is a three-wave, this low here at $1.77 should be taken out in the next rundown. And then once this market take out this low here, it will get interesting. I'll be eagerly watching for a reversal because this is a break here will take out a lot of weak hands. And if these people are induced to sell on the breakout of this low here, then it will trap all these people who sold. And if the market ends up back up again, that will be the signal that this market has finished its corrective move. Now, this market is the bigger box is green, telling me that the market is essentially bullish, coupled with the fact that all the fundamentals suggest that we probably will see higher prices going forward. I am biased, okay, as far as this token is concerned. Okay, I'm not going to show you more unless you guys want more. Okay, let me see any other question here. Dennis, what is the difference between Ripple and XRP? Now, now Ripple Lab has a blockchain called the Ripple Lab blockchain. Now, the XRP is the token that we are trading. Okay, so there is a blockchain and there's a token. So the blockchain, of course, has a use case. It is used largely as a payment solution because it is very, very cost effective compared to if you send money through Swift, it'll be not only lengthier to resolve, it's also more expensive. Ripple can do the same thing for next to nothing. So a lot of banks are using the Ripple blockchain for their payment aggregation. Okay, so it has reuse case. And now it seems that the SEC has decided not to pursue, okay, the legal case against Ripple when they launched their token, because previously the previous SEC chairman has always wanted to sue Ripple for offering a security without a security license. That has largely been resolved. The SEC is no longer pursuing that case. Okay, so that should take away, that should clear the overhead clouds that's been hanging over Ripple for all these years. So, yep, that's my understanding. Lily is asking, is weak US equity markets have simultaneously trend with coin-based market? That is, okay, the crypto market has been on a relative basis a relatively new market. So there are times they are correlated and there are times they are not correlated. If I want to look at it this way, if I look at all these digital assets similar to, let's say, precious metals, then maybe they do belong in the basket where we call it as risk off. Okay, but on the other hand, tokens are very volatile. People trade digital assets and they like the volatility. That means to say that it is also sometimes confused to be risk on as well. So again, it all depends. If the market has no choice, all these traders and money managers needs to produce a yield. So it all depends on where they put the market. Right now, equity markets in the States is not doing too great. Okay, so obviously money has left Wall Street. But when it leaves Wall Street, it has to be parked somewhere else. Either it parked in equity market elsewhere, which could possibly be the case, okay, because we are seeing funds flowing into Singapore equity markets. So that could be one play, okay. The other thing is, if money is not in equity market, it must be in the bond market. Has bond market been doing well? I would not want to touch bond market with a 10-foot pole. Okay, so if it's not bond market, it's not equity market, it has to go somewhere. So right now, it seems that people are putting money into precious metal for that geopolitical outlook. But they will come to a point whereby maybe the coins, okay, could be a proxy, okay, for something like like precious metals. So it's difficult to categorize the digital assets because there is not enough history to actually pigeonhole them into one asset class. Okay, it's just neither here nor there. Sometimes they move in tandem with equity markets, sometimes they don't. Okay, so hard to say. But look at the price chart. Okay. All right, guys. I think I have come to the end of this evening presentation. Uh, unless you have further question for me, and I'd like to wish all Muslims happy. What you call that? Selamat Hari Raya. All right. Thank you, boys. Thank you very much, and I'll see you next Sunday. Bye bye.